All right, so you're going to sell your business, and obviously that means you're going to get paid. But what form is that payment going to be? I mean, when are you actually going to get the money? If you're thinking about selling your business, today's video is going to be extremely important for you. Stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it.
Are you a small business owner that's thinking about exiting your business now or in the next few years? My team and I are here to help with our unique zero commission program that we've been using since 2016. We can show you what your business is worth, prepare the package you'll need before you meet your first buyer, even run a confidential online advertising program for you just like business brokers do. And we'll coach you through the whole process, or you can hire us to manage it all for you, including coordinating your whole sell-side deal team. Head over to howtosellmyownbusiness.com to learn about how my team and I can help you get ready by watching a series of videos we prepared that explain each step in detail. And if you're ready or just curious to learn more, reach out to us and we'll get you started or schedule a call to answer your questions. I look forward to meeting you and learning more about your business. All right, welcome everyone. So today we're going to be talking about terms of sale, and that means how someone gets paid for their business when you actually arrive at closing day. So these terms of sale are not going to be a surprise. It's going to be a part of whatever offer that a buyer makes to you. It's going to be contained within a document, an offer to purchase, letter of intent, um, um, indication of interest. I mean, there's a bunch of different documents. Sometimes it even comes in the form of an email where someone just says, "Hey, I'd be willing to buy your business, and here's what I'd be willing to do as far as paying you for this business." And it kicks off that conversation. And through the course of negotiation, the terms of sale often get changed around until you accept something, and then they can even be changed around again once other third parties start to play a role in this conversation, like lenders and other people. So today we're going to be talking about this whole concept of cash versus terms. One of my good friends and clients, a member of the group coaching program, has actually kind of imagined it like a machine with knobs. And if you move one knob, the other knob has to move as well. And so these are like things that are adjusted as we work through a deal. And today we're going to talk about, why it is that the buyers are looking for this from you and what kinds of things you need to think about before you even meet the first buyer that are going to help you prepare for what is likely going to be in your transaction. So I've got a whole outline here lined up. So, first of all, let's talk about cash offers. So, is it possible to sell a business for all cash and get paid cash on closing, just like selling a house? And when I say cash offer, what I'm talking about is what the seller receives from their point of view. So, a cash offer would be a big check, right? I'm going to buy your business for $1 million. Here's a check for $1 million. Now, that doesn't necessarily mean that the buyer has $1 million. They could be borrowing some of that money from the bank. But from the perspective of the seller, it is a cash offer because they're being paid entirely on closing day. So, what kind of businesses or what kinds of deals are going to be the ones that are likely going to get these cash offers? I've got a whole list of things here. So, number one, if the price is clearly a super good deal, right? So oftentimes when we're in a hurry to sell something, one of the natural reactions people might have is let's offer it at a lower price in hopes of attracting a buyer. And so certainly the lower the price is and the better the deal seems to be, the more likely you're going to have someone who's going to be willing to pay all cash on closing for a couple of different reasons. Number one, the low price will kind of remove some of the riskiness of the deal. People will see it as more of a sure thing, and it will be more likely that the buyer will be able to get the money they need from us, like a bank. right? So it's going to be easier for the bank loan to cash flow. It's going to be easier for the buyer to demonstrate the ability of their future selves to repay that loan. If the price is low enough, it's going to make the bankers feel more comfortable. They're going to be more willing to make the loan. Um, and this eliminates basically the need for seller's participation close sale after closing. I mean, because if you get cash on closing, you may be required to have some kind of transition period where you teach the buyer certain things about your business, but what really ties you into it? Not a whole lot, and that's one of the reasons why people may not want to do this. Well, we're going to get to that later. Number 2, business stability. So businesses that are likely gonna be, receiving an all-cash offer are gonna be ones that have proven financial performance and steady revenues that are going to be demonstrable. So if you've got nice clean books that show great profit and you have a regular pattern of activity. I'm not gonna talk about high growth because high growth has problems we're gonna get into. But if your business grows at the rate of inflation or slightly better than that in revenue and your profits equally are just steady growing at a reasonable rate over the course of time, and you can show someone like 8 years of financial statements showing this kind of growth pattern, it is far more likely that someone's going to be willing to pay all cash. So, what other kinds of businesses or assets out there have this kind of profile? Well, something like an apartment building, right? You know, you're going to have empty apartments, but you're not going to have all the apartments go empty, right? And you're going to have that sort of steady cash flow over time. The rents go up a little bit, right? Costs go up too, but performance should increase over time. And so this is why it's quite normal for people to buy something like an apartment building and pay all cash on closing. If your business has a similar track record, it is going to be more likely that someone's going to be willing to pay cash on closing. Um, that is going to look like a less risky business than one that has cash flow, earnings, and revenue bumping up and down and going all over the place. So performance over time, it's going to influence whether someone's going to make a cash offer. Market demand. If you happen to be in a highly sought after business, then you're more likely going to be getting an all cash offer. So over the course of time, where have I seen this? I have always seen this in what I call the simple operation businesses. So these are the corner stores, gas stations, simple little food businesses, etc. And one of the big reasons why there is a big demand for those kinds of businesses is because of newcomers to the country. So if your business can be easily executed by somebody who faces a language barrier, then there's more likely an opportunity for you to sell for all cash because somebody who is looking for a simple business to run, even though they may not have a great command of English, for example, if we're talking about the U.S. or Canada, then they're going to see your business as one that they can operate. And there's a lot of people coming into the country that have money for this kind of thing, and so there's going to be this high demand. Same thing can be said for things that are perceived to be easy to operate, like laundromats. And lately, there's a lot of excitement about home service businesses, things like HVAC businesses. And so I've seen and heard of lots of deals where people are paying strong prices and paying all cash because they're really under this um, motivation or compulsion to get their hands on that kind of business because they believe so strongly in that model. So high demand. The number 4 thing that's going to influence an all cash offer is asset mix. So business is risky, but if you have a business that you're going to sell for $500,000 and it happens to come with $450,000 worth of equipment and inventory, for example, well, the buyer's really making an investment that is just slightly more than the stuff they're getting on closing day. And so buyers are going to perceive this kind of investment as having more than one exit route, right? So if the business can't be executed successfully, at least they can try to liquidate or sell the stuff. And this provides another way to get out. So a business with a high volume or a high amount of tangible assets or things that are worth money in that transaction, they're going to be more likely to be open to an all cash deal. And then the last one is a little bit of a special one that I added here at the end. And I'll talk a little bit about this. The last one would be buyer ignorance. So if the person approaching you to buy your business just has no idea what they're doing and they haven't been watching my YouTube channel, for example, then they may be more willing to make this all cash offer. And it's funny because I actually had a messaging exchange with somebody who does Q of E reports, quality of earnings reports, which are due diligence analyses of businesses. I was chit chatting with them on LinkedIn the other day, and they were talking about the number of terrible offers that they've seen recently. And it's buyers who actually gone through some of these high ticket programs that are advertised online by these, infotainment gurus. And they're making offers, he said, that don't even cash flow, right? So these people are basically negotiating deals and then going to him to get a quality of earnings report, and the deal they have, if they successfully execute on it, is certainly going to be a business that will fail for them. Like, so ignorant buyers making all cash offers. Uh, I can tell you over the course of my career, I've met many business owners who bought their business 20, 30 years ago, and they did all cash deals. And they'll say to me, I just didn't know you could do anything else because the information wasn't available. There wasn't the huge volume of content that you can access today in the form of books, YouTube channels like mine, et cetera, that showed people how they can manage risk through doing some kind of deferred payment strategy, which we're going to get into in a minute. And so they made all cash offers. I've heard crazy stories like people borrowing hundreds of thousands of dollars against their house to write a check to a seller. Um, so if your goal in selling your business is just to wait for an ignorant buyer, it's becoming increasingly difficult for that strategy to work. But that would be the last, sort of reason why somebody would want to make an all cash offer on a small business, highly risky asset. So let's talk about the factors that lead to what we're going to call flexible terms or deferred payments. So I'm going to get into the different kinds of deferred payments. They fall into two general camps. But deferred payments simply means that on closing day, you don't get all the money. So you sell your business for $1 million. On closing day, maybe you get 600,000, and the other $400,000 is paid out over time based on whatever factors we're going to negotiate. So we're getting into the deferred payments section here now. So why would somebody be asking you as a business seller to wait for part of the money? So I've got this into a bunch of different categories as well. So number one, if it's a high price, right? So if you're asking such a high price for your business and you insist on getting that high price, the buyer, between the down payment capital that they have saved up and what they can borrow at the bank, they just can't get all the money, right? So if they just can't get all the money, where's the rest going to come from? It's got to come from you, right? That's it. Either that or you wait for a buyer that has more money. And then the question is, how motivated are you to sell? Are you willing to sit there trying to sell your business for years and years and years? Because believe me, that I've seen it, right? I've seen people put a business up for sale that has a really high price, and they have one, two, three, four buyers in a row make offers, and then the offers all include seller financing. They keep saying no, uh, waiting for that unicorn buyer, while they become increasingly tired of the operations. They become increasingly wary of having to do the work, etc. Their attitude starts to erode the quality of the business, and then you're in a death spiral, right? Then you start to have years of decline. And that's not what you want as a seller. So number two, the higher prices often require earnouts to justify against future performance to justify those high valuations. And if a lender is involved, there is likely going to be a standby requirement. So what does that mean? Well, if you are asking a really high price, and if the buyer is going to take such a huge loan that the cash flow of the business can't service the debt, the lender's not going to lend all that money. They're going to say, we're only going to lend this amount of money. And we're not going to let you pay the seller what they're owed until we're paid. So not only are you getting deferred payments, but you may have a gap in your payments. You might have to wait 5, 6 years, 7 years, or more, even 10 years. I've seen in some deals where the seller gets their closing day money because it's a combination of the buyer down payment and the bank loan. And then the bank's rule is, now you got to wait until we're paid in full before you can start getting your money. And so if you want the really high, sky high price, you can do it. Just be prepared for what's likely going to be asked of you, and know that there's a lot of things you're going to have to put into making sure that you are going to be safe in waiting a decade potentially for the rest of your money. And I'm going to talk about that today. So, the risk factors. So, like a business that has unstable cash flow and earnings, if your sales and revenue go up and down by 20 or 25% every year, it's going to be very difficult for a bank to trust the cash flow is going to be there to service the debt. So, a bank is going to want to lend less money, which means where does the rest of the money come from? Is going to come from you. Okay. This is another reason for deferred payments. Seller financing also serves as a confidence signal. Okay. So when sellers are willing to finance the buyer, you are literally making an investment in the buyer's business. And so what does that do? It shows that you as a seller have faith in the business, number one, that you think the business is going to do well, faith in the market, number two, and faith in the buyer, number three. So it not only gives the buyer confidence that they can do this because they know that you believe in them, it also gives their lender confidence that you believe in the buyer. And so the lender feels more confident being able to do this loan because they know that the person who knows the business better than anyone, you, the seller, are willing to do this seller financing. The the other category here is the buyer type. So who is this buyer, right? So if it's a first-time buyer, for example, they're likely going to have more limited resources, and they're probably going to request flexible terms because they just don't have the money to pay more on closing day. And because they don't have a lot of money to pay more on closing day, that could affect how much the lender is willing to put in, right? So if the lender is always worried about the buyer having skin in the game. And so they wanna know that if something goes wrong, this buyer is gonna work like crazy to try to make the business successful so that they can save their own investment. Well, if the buyer hasn't made a very big investment, it makes it harder for the bank to justify making a huge investment in the deal. And so there are lots of lenders who will look at the amount of seller financing and the terms of the seller financing or, however it's structured, and they'll almost look at seller financing that's locked in while the bank is owed money to be kind of like equity left behind by the seller. And so that then gives the bank the impression that if the buyer has any kind of problem, the seller is going to be there to back them up, give them advice, coaching, etc. And again, it's another indicator of your confidence as a seller in the person you've chosen. Number four reason why someone's going to want more flexible terms would be the corollary to one I mentioned earlier. So the lack of tangible assets. So it, if your business is like a service business with very few assets, or it's very IP heavy, like some kind of software business or a brand business where everything's all the manufacturing's contracted out, but you control a brand and a product, etc. There's just not much for people to put their hands on. And so what this means is that the only path for success for this business buyer is successful business operation execution. They have to operate it correctly to make it work right to produce the cash flow. And this is the only path they have to get out of debt. You might think, hey, well, that's just business, right? But from a buyer's perspective, it means with no plan B, no ability to recoup their investment through, potentially selling assets if things don't work out, then it really starts to highlight just the risk nature of small business. And so as people start to look at the possibilities of what could happen, and there's a vast array of possibilities, competitors that are outside the control of you as a seller or the buyer. So there's things competitors can do, there's regulatory threats from the government, there's, the threat of imports or, new entrants into the market. There's a threat, macro threats to the economy. If the economy has a downturn and your product or service is considered discretionary, people may not uh, buy that thing anymore because they need the money for groceries, right? So there's all these risk factors, and if the only way to ever get their investment back and earn some money on buying your business is through successful execution, that's going to highlight the fact for the buyer that this is a risky endeavor and that they need to make sure that they are sharing the risk in some way. And that means a deal with deferred payments. So let's talk about the pros and cons of seller financing, because I said there's two different kinds of deferred payments. There's a fixed amount that you are owed over time. This is a debt. So think of yourself as a lender to the person that's going to buy the business, right? And the amount that they owe you is a fixed amount, and you are going to create some kind of terms. There's going to be a payment per month or whatever it's going to be. So, what are the pros? Number one, by being open to doing seller financing, you will increase the pool of potential buyers because now buyers with less money or less financial strength are going to be able to do a deal for your business. More buyers means more options for you and potentially competition between buyers, which is going to drive up the price ultimately, right? So that's the number one advantage. Number two, this can then justify the higher selling price. Um, I'm going to mention a couple of videos here in a minute, but being willing to be the bank for a buyer is worth something. Like that is a service that someone's willing to pay for, which it directly translates into a higher price for your business. Um, Another reason why you might want to do this is you actually make more money through collecting interest on the loan payments, right? Most seller financing notes have an interest component attached to them. And it's interesting because when people are doing a business deal, like right now at the time of recording in January of 2025, business loans are like 9, 10% ish in that area, right? If you got paid all cash for your business, where can you go deposit your money and earn that kind of rate of return? Like, there's no place that you can do that. But by lending the buyer money, you can command the same interest rate or even a little bit more than what a bank is asking for and get a really great rate of return on the interest potentially, right? Sometimes if you're asking for a really, really, really high price, the only way the buyer will be able to afford that is by you getting a lower interest rate. But still, where can you get maybe 5 or 6% on a deposit somewhere, right? So there's an appeal to this from your own personal asset, portfolio investment mix that it can be quite lucrative. Um, and that means that investing in these seller finance notes basically is what you're doing, is going to provide a better yield. Now, there's two videos I want to point out. One of them that I recorded in October of 2018, it was an interview with a seller called Business Seller Maximizes Profit by Financing the Buyer. We'll put a link to that here and down below in the show notes, that you might want to check out, where I interview a guy named Ian who sold his garage business. He actually sold the business and the building, and then held the mortgage and the financing on it. And he talks about how he came to rationalize why this was far more lucrative to him than selling the business with and being paid on closing day. And then there's another video, which is a pretty popular video that I did back in June of 2021, called "Why Would a Seller Want to Finance the Deal?" And we'll put a link to that one as well. Um, some other benefits of doing some seller financing. It can provide a way for you to defer some of the tax obligations into future years when you receive the money from the sale. And so you talk with your CPA about that, how that would work and how it might benefit you. And that's a conversation where you have to kind of tie in the other financial aspects of your life, to see, if there's real advantages for you to defer part of that taxation into the future. And here's one that many people don't talk about. So another big advantage of financing this transaction and holding a note is that you can register your seller financing. It might be behind a bank if there's a bank involved in the deal, or maybe not if there's no bank involved. If something bad should happen with the buyer, if they should somehow fail in the business, as a lender, you will have different options open to you to potentially take back the business. Now, if there's an outstanding bank loan, it might mean that you have to take care of the bank. You might have to pay them out or at least assume the balance of the payments. Don't forget, you received, some degree of money on closing day from the buyer and potentially from a bank loan. And then you received payments over a couple of years probably before this might happen. So you could have received 75 or 80% of your money at this point. The buyer then fails. You have the option, not the obligation, to step back in some fashion and take the business back and potentially restore it to its previous profitable self and then sell it again. So, under a scenario where a buyer, like I'm always talking with sellers who say, I don't want to finance the deal. What if the guy doesn't pay me? Like, when you consider what you could happen and realize that this could be an extremely lucrative outcome, you realize that yes, there's risk in doing the deal, um, but there's also opportunity. And it really comes down to where you're at in life. If you're 70 years old, at 75, you probably don't want to be repossessing a business. But if you're younger and you're selling for some other reason and you are still available to come back and take it over if you need to, it's going to be a different kind of risk analysis from your point of view. And that's kind of the highlight that I want to make here is that as a seller financing part of the transaction, you are making an investment. We're going to talk more about this as we move on. Um, the cons. So here's the cons of doing seller financing, which are probably pretty obvious. Number one, there's a delay in the full payment and introduces potential collection issues if something goes wrong in the business, um, and increased risk if the buyer fails to meet payment terms or if the business underperforms. The second type of deferred revenue or deferred payment for a business is called an earnout. So, an earnout is you getting money based on future performance of the business. And I've recorded videos before about earnouts and how they can come into play. We'll put a link to one here. So, when are they used? Um, it gets you a higher valuation tied to potential. So, if you're about to sign a big contract with the Navy or something, then maybe you want a taste of the profit from that contract that the buyer ultimately will take over, right? So that's kind of, but we don't know if the contract's going to be signed or not. And so it's uncertain. So that kind of thing would definitely be something that you would tie into an earnout. It's also a risk sharing mechanism between a buyer and a seller. So the benefit for the seller is that it allows you to achieve that higher asking price if the business actually does perform, and it provides sellers with an incentive to stay involved post sale to try to smooth the transaction and even help make the final sale come across the line. So in that example I just gave, if you've been working for 2 years on this Navy contract, for example, and you sell your business, you might still want to be the lead person on the Navy contract if you potentially are going to get a piece of the profit that comes from it. And so where I see this coming about in particular is when people have, I mentioned during the cash, why would someone pay cash? Even eddy steady performance of the business. Well, if you don't have that, or if you have rapid growth, so we've seen this a lot post-pandemic years, where people will have this business which has performed like say $1 million of revenue every year for years and years and years. Pandemic hits, things go down, then it recovers and goes up to 1.5 million, right? And they've never had sales that high before ever, and the profit has never been so high. And then immediately the seller lists the business for sale with a broker, and they use this last and best year of performance as the entire basis for valuation and asking price. And I mean, if you are in that situation, if you've met a business broker who has said, let's value it entirely on the last year and put this price on it based on the future always performing like this best last year, then you're not dealing with a qualified business broker. Okay. I can tell you that because any qualified business broker is going to say to you, look, any buyer is going to look at your track record and they're going to say, this last year could be an aberration. It could be something that is not repeatable until you have 3 years of performance, I would say, at this new higher level. We can't price the business based on this higher level. Every buyer that looks at the business is going to do some kind of averaging of the last 3 or 5 years, and they're going to price the business based on that average value. So, how can you take advantage of this great high performance? You're going to tie it into an earnout. You're going to say, this is what I want for the business, but this portion of the value has to be tied to the continued performance of the business at this higher level. And if you, as a buyer or as a seller, are saying, well, I don't know if the business is going to perform at this higher level, then that's an indicator to you that you lack empathy in the deal. You're not thinking about it from the buyer's point of view. And we're going to get into that in a minute. So the benefits for sellers in doing these deals, I just told you. So it lets you get a higher price, and it provides you with an incentive to stay involved post deal. The challenges with earnouts is that there could be potential disputes over performance metrics. So it has to be very clear and easily understood what the terms and conditions are that get you that extra money. And so this could be in the form of like a royalty. Like you could say, I get a percentage of all revenue over a certain amount in the next 3 years, for example. Or it could be in the form of a forgivable note. So you could say, You owe me a balloon note for $100,000 due in 4 years' time. But if the business doesn't hit these metrics, the loan is forgiven, right? That's another example of an earnout, right? It's more money in the future, but based on performance. And in your agreement with the seller or with the buyer, you have to have clear and enforceable terms outlining exactly what's going to happen and when. So, here's some tips for sellers for navigating cash versus terms in doing one of these business deals. So, number one, understand your business risk profile. Now, you are knee deep in your business. You live in it every day. You know everything about it. And from your point of view, with your experience, you don't see the risk. I'm telling you, you don't, right? So, you want to conduct an objective review with who? With your business owner friends. So, most business owners hang out with other business owners. And what you want to do is you want to use those people as a sounding board and you want to say to them, if you were going to buy my business, what risks do you perceive in my business? What would make you frightened of wanting to buy my business? Right. And get their feedback. And you will be surprised about the things that they say. You may not be, but in my experience, a lot of sellers are surprised by the things that come up in these conversations. You want to then understand the skills that your buyer is going to need in order to be successful in your business based on these risk factors. And you want to select a buyer in the same way that you might hire a CEO to replace you. If you just said, I'm going to keep the business, I'm going to hire someone to run it for me, what would that person look like? Those are the kinds of things you want to look for in a buyer because you are making an investment in that person. It would be like if someone came up to you and said, hey, I got a business idea. Do you want to invest? You're like, how would you examine that investment opportunity? The same thing is happening when you sell your business and you're getting some kind of deferred payment. You are making an investment in that person, in their business. It just happens to be a business that you know intimately. And that's what makes you an ideal investor in that business because you understand the business, you understand what is possible, what is probable, and you're going to know what kind of characteristics and strengths and experience the buyer needs in order to be successful. This is why deferred payments are a confidence indicator for bankers and buyers. Because if you are doing a good job as a seller and really examining that buyer to make sure you're choosing the right one, well, that you have confidence in them. It's legit. It's not like a tactic for selling your business. Like you're entrusting that person potentially with hundreds of thousands of dollars of your money that will be paid one day if you make the right choice. And so this is why buyer selection is key, and to make the best choice, obviously, you want the widest variety of candidates, which means if you if you actually let people know that you are open to deferred payments, you will attract more buyer interest. You will have a greater field of candidates from which to select. Um, Prepare for buyer concerns. So I already talked about the risk factors that you're going to get feedback from your friends. If you don't have a lot of business friends, get to know Chat GTP. Just say, I'm thinking about selling my business. Let me describe it to you. Maybe you can upload some financial statements, and then you can just ask Chat GTP. What risk factors do you see as a potential buyer, or what things do you think that a buyer might potentially have problems with? And what you're doing is you're preparing yourself for the conversations that you're going to have with the buyer, and you're learning to look objectively at your own business. Understanding these concerns will then allow you to negotiate thoughtfully. So, you know, one of the things that I coach buyers to do is I actually coach them to make more than one offer at the same time. So they could make a cash offer and an offer with seller financing and an offer with an earnout potentially. And these three offers could have different prices, right? Because we want to show sellers that the terms hold value for the buyer and that different risk profiles of each business warrant a different kind of valuation based on the terms. And so if you spend some time thinking about this, maybe you're talking with someone who wants to buy your business who sent you to this video, for example. When you put some time thinking about this, it's going to better prepare you for the kinds of offers that you might receive so that you don't ignore good deals. One of the most tragic things that I hear about from business owners when they're trying to sell is that they will try to sell a business sometimes for years, even with the help of a broker. They can't sell the business, they don't get any offers. They eventually find me online and they engage me to help them, and they say, can you help me? Why isn't my business selling? I'll look at their business, say, well, it's overpriced. This is the problem. And here's what a likely offer will be. And then some of them actually say, oh my God, someone made me an offer like that. And I did not know it was reasonable. Right. So this is why you want to be prepared and you want to think about this from the buyer's point of view. Leverage expert advice. So you want to work with qualified business brokers. So you want to understand that they know what they're doing. I wrote a book called How to Sell My Own Business. The first half of the book is all about how to determine whether a business broker is qualified or not, and when you should use a business broker versus trying to sell it on your own. So check out that book. It's on Amazon, howtosellmyownbusiness.com. Um, you want to work with business brokers, attorneys who frequently deal with small business transactions, appraisers. You can work with me and my team. This is what we do all the time. We're working with people like you, and understand what they've seen and what their feedback is and what they think is going to be a likely type of deal for you in selling the business. Number 5 tip for negotiating this is you want to maintain visibility and oversight. So I've already said before a couple of times, you are an investor in the buyer's business. So just like any investor or a lender like the bank, you need to have visibility and oversight into what is happening in the business. So don't be afraid when you're negotiating to actually ask for the kinds of things that lenders would ask for. So you could say, I want monthly income statements. I want your annual copies of tax returns. I want annual financial statements from the accountant. You can go deeper than that because you intimately understand the business. So you could say, I want, uninterrupted back end access to the point of sale system in viewer only mode, where I can go in and look at what's going on in your business. You want me to invest $700,000 into your deal? Well, great. I want to be able to log into the POS whenever I want. Or you can get, even more specific. I once helped somebody sell a bar, and one of the conditions that the seller had for the seller financing, because like banks won't finance a bar, so the seller knew that they were going to have to finance. But one of the conditions was that they wanted the reports from the automated liquor dispensing system, as well as copies of bank statements and the internal income statement or P&L. And so this buyer was producing all this paperwork every month and sending it to the seller. After a few months, the seller called the buyer and said, "You've got a bartender stealing from you, and this is how I know." Right? And that's the value. Again, buyers see deferred payments as a way of offsetting risk, and that highlights exactly how. Because your experience is still going to be involved to some degree as you look at what's going on in the business, and you can spot things maybe earlier than the buyer can and give them a heads up to help keep them on track, with the goal ultimately for you of simply collecting your money, right? And business is risky. This is one of the ways that the buyer wants to offset risk. And one of the ways that you can offset the collection risk is by maintaining a certain degree of oversight and participation. And so you always need to be ready to act as a coach, advisor, etc., long after the transition period. I mean, in the agreement to sell your business, you're going to be asked to stick around for so many weeks or months. And then the buyer's going to want to have access to you maybe over the phone for a year or something after that. In my experience, what typically ends up happening is you're going to end up talking to that person for a lot longer than that. And you're going to want to, because you're going to want them to succeed so that you can collect your money. And if the deal was done properly, if the deal was done collaboratively, and you really got a chance to know that person before the deal closed, and you chose the right person, and you can see their success, and you can see them protecting and maintaining the legacy of the business that you built, you will become friends with that person and you will want them to succeed. That's been the track record that I've seen over time. So, in conclusion, there is a trade off between cash versus terms in selling a business. The higher the price, the more likely you're going to have to do some form of deferred payments over time. This is a way that the only way often that buyers can make a deal happen and can control the risk of them being able to manage the business and continue to have the performance go the way you have. You need to look at your own situation objectively, understand that you have a bias because you know the business and the industry so well. somebody from outside the business or outside the industry is going to see risks that you don't, right? So you need to be able to look at this from a fresh point of view. And, if you want to learn more about this whole process of selling your business, I think the best thing I can do is direct you over to my website, which is howtosellmyownbusiness.com. Over there, there's a playlist of videos. There's links to the book I mentioned, which is called How to Sell My Own Business. You can get that on Amazon. But there's also a demonstration of the process that I take business owners through when I'm helping them sell. So we do an evaluation, then we do the packaging of documentation for the buyers. Then we help people through an advertising program. We coach people through the process. And we even have an offering there where we kind of take the whole thing and provide it all in one package. So head over there to howtosellmyownbusiness.com and check that out. And with that, I'll say thank you very much. And I'll wish you the best of luck in selling your business. And stay tuned. Don't forget to hit subscribe because there's more great videos already on the channel and coming out every week, as well as amazing interviews. And with that, I'll say see you later. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.